People ask me all the time what I'd do if I were starting over. They want to know how Warren Buffett would invest if he had to begin from scratch, with no billions of dollars, no reputation, no access to special deals, just $10,000 and the knowledge I've accumulated over more than 7 decades of investing. And I'll tell you something, I think about this question more than you might expect, because the answer reveals everything about what really matters in investing. Here's the truth. If I woke up tomorrow and someone handed me $10,000 and told me this was all I had to build wealth for 2026 and beyond, I wouldn't be worried, not even a little bit. In fact, I'd be excited, because the $10,000 is more than enough to start building real wealth if you know what you're doing. And the principles that made me successful with billions work just as well with thousands. The math is the same, the discipline is the same, the patience is the same. But before I tell you exactly how I'd allocate that $10,000, I need to explain my philosophy. Because if you don't understand the why behind the what, you'll end up abandoning the strategy at the first sign of trouble. And trouble always comes. The market crashes. Stocks you own fall 30 or 40%. Something you were sure about turns out to be wrong. If you don't have a solid philosophical foundation, you'll panic and make terrible decisions. I've seen it happen thousands of times. My philosophy boils down to a few core principles. First, I'm buying businesses, not stocks. When I purchase a share of a company, I'm not buying a ticker symbol or a line on a chart. I'm buying a fractional ownership stake in a real business with real products, real customers, and real cash flows. This might sound like semantics, but it changes everything about how you think and act as an investor. Second, I only invest in businesses I understand. This is absolutely critical. I don't care how hot a company is or how much everyone says it's going to change the world. If I can't explain in simple terms how it makes money and why customers will keep buying its products 5 or 10 years from now, I don't invest. This rule has saved me from countless disasters over the years. It kept me out of the dot-com bubble. It kept me away from crypto speculation. It keeps me focused on what I know. Third, I want businesses with durable competitive advantages. I call these moats, borrowing a term from medieval castles. Just like a wide moat protected a castle from invaders, a competitive advantage protects a business from competitors trying to steal its customers and profits. The wider the moat, the safer the business, the more predictable the returns. Companies without moats are constantly fighting for survival. Companies with wide moats can raise prices, maintain margins, and compound wealth over decades. Fourth, I insist on buying at a reasonable price. Notice I didn't say a cheap price. I used to be obsessed with buying cheap companies, what Ben Graham called cigar butts. You'd find a company trading below its liquidation value, buy it, and squeeze out one last puff before discarding it. But Charlie Munger taught me that it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Wonderful businesses compound value over time. Fair businesses just sort of exist. And fifth, probably most important of all, I think long term. My favorite holding period is forever. I'm not trying to flip stocks for quick profits or trade around earnings announcements. I'm trying to own pieces of businesses that will be worth substantially more in 10 or 20 years than they are today. This long-term orientation changes everything. It means I don't care about quarterly fluctuations. It means I can ignore market noise. It means I can be patient while compound interest works its magic. So with those principles in mind, let me tell you exactly how I'd invest $10,000 for 2026. I've thought about this carefully, and I'd split the money into 4 positions. Not 10 positions, not 20 positions, 4. Each one representing a business I understand completely with a wide moat at a valuation that makes sense for long-term holding. My first allocation, and this would be the largest, is $3,500 into the Vanguard S&P 500 Index Fund. Now, I know what you're thinking. Warren, you just said you pick individual stocks. You're famous for concentrated positions in businesses you understand. Why are you putting 35% of this portfolio into an index fund? Let me explain. because this is important. When you're starting with $10,000, you have constraints that someone with $10 million doesn't have. You can't own 50 different stocks because the transaction costs would eat you alive. You can't properly diversify across sectors and industries with such a small amount. And frankly, most people, even smart people, aren't going to outperform the market consistently over time. I've said this repeatedly. For most investors, low-cost index funds are the best choice. But here's the thing. I wouldn't just own an index fund. I'd use it as a core holding that provides broad exposure to American business while I make concentrated bets on specific companies I think will outperform. The index fund gives me a stake in 500 of America's largest companies, including many wonderful businesses I couldn't afford to own meaningful positions in with just $10,000. Companies like Microsoft, Amazon, Google, Nvidia, Meta, these are great businesses. And the index fund lets me participate in their growth. The S&P 500 has returned about 10% annually over the long run, including dividends. That means my $3,500 should double roughly every 7 years. In 20 years, it could be worth $24,000 or more, assuming historical returns continue. That's a solid foundation for any portfolio. And it requires zero effort, zero research, zero monitoring. I can set it and forget it while focusing my attention on the individual stock positions. There's another reason I'd allocate heavily to an index fund starting out. It protects me from myself. The biggest risk in investing isn't market crashes or recessions. It's making stupid decisions, buying something I don't understand because everyone else is buying it, selling in a panic when prices fall, getting overconfident after a few wins, and taking excessive risks. The index fund portion of my portfolio can't hurt me. It's broadly diversified, low cost, and as close to a sure thing as exists in investing. Now, my second allocation would be $2,500 into Berkshire Hathaway. And yes, I know this is my own company, but I'm not recommending it because of ego or self-interest. I'm recommending it because if I couldn't run Berkshire, I'd absolutely want to own it. Let me tell you why.
Berkshire Hathaway is essentially a diversified holding company with stakes in more than 60 wholly owned businesses plus a massive stock portfolio.
When you buy Berkshire, you're getting exposure to insurance, railroads, utilities, manufacturing, retail, and more. You're also getting exposure to our equity holdings like Apple, Coca-Cola, American Express, and Bank of America. It's like buying a mutual fund of businesses I've chosen, except it's structured as a corporation and manages itself with no annual fees eating into returns. But here's what really makes Berkshire special for a small investor trying to build wealth. The company is designed to survive anything. We have over $150 billion in cash and treasury bills. We have no meaningful debt at the parent company level. Our operating businesses generate enormous cash flow year after year. We don't pay a dividend, which means all the earnings get reinvested back into the business at attractive rates of return. For a young person trying to compound wealth, that's exactly what you want. Let me put this in perspective. If I had bought $10,000 worth of Berkshire stock in 1990, it would be worth something like $400,000 today. That's a 40 times return. And that wasn't from speculation or luck. It was from owning a collection of good businesses run by capable people who made rational capital allocation decisions over decades. The formula hasn't changed. We're still buying great businesses, still maintaining financial strength, still thinking long term. At the current price, Berkshire trades at roughly 1.3 times book value. That's not expensive for a collection of businesses this high quality. There's a reasonable chance that over the next 10 or 15 years, book value per share grows at 8 to 10% annually. Add in share buybacks, which reduce the share count and increase per share value, and you're looking at potential returns that should beat the market over time. That's worth 25% of my $10,000 portfolio. There's also a psychological benefit to owning Berkshire that shouldn't be underestimated. The company doesn't report quarterly earnings in the traditional sense. We don't give guidance. We discourage short-term thinking. This structure helps shareholders like me avoid the temptation to obsess over quarterly results and instead focus on long-term business performance. When you're trying to build wealth over decades, removing sources of anxiety and distraction is valuable. My third allocation would be $2,000 into Apple. Now, Berkshire already owns a huge position in Apple, so I'm getting exposure through my Berkshire shares. But I'd still want to own Apple directly for a simple reason. I think it's one of the best businesses in the world, and I want as much exposure to it as I can reasonably have within a diversified portfolio. Let me tell you what I love about Apple. First, the company has created an ecosystem that customers simply don't want to leave. Once you're in the Apple world with your iPhone, iPad, MacBook, Apple Watch, AirPods, all seamlessly connected and integrated, the switching costs to move to a competitor are enormous. Not just financial switching costs, but psychological and practical ones. You lose your apps, your photos, your messages, your convenience. Very few people are willing to make that sacrifice to save a few $100s. This ecosystem creates incredible customer loyalty and recurring revenue. People upgrade their iPhones every few years like clockwork. They buy new AirPods when the old ones wear out. They pay monthly subscriptions for iCloud storage, Apple Music, Apple TV Plus. These services are growing faster than the hardware business and have much higher profit margins. Apple is systematically transforming itself from a hardware company to a hardware and services company, and the services piece is incredibly valuable. Second, Apple's brand is arguably the strongest in the world. People aren't just buying phones and computers. They're buying status, quality, reliability, and membership in a tribe. The Apple logo means something. It says you value design and user experience. It says you're willing to pay a premium for the best. That brand loyalty allows Apple to maintain premium pricing even when competitors offer cheaper alternatives. And premium pricing means fat profit margins. Third, Apple's balance sheet is a fortress. The company has over $60 billion in net cash, even after spending hundreds of billions on dividends and share buybacks over the past decade. During economic downturns, when other companies are scrambling for financing, Apple will be able to invest in innovation, buy back shares at depressed prices, and potentially make acquisitions. Cash gives you options, and Apple has more options than almost any company in the world. Fourth, Apple generates absurd amounts of free cash flow. We're talking about nearly $100 billion annually. That's cash available to return to shareholders or reinvest in the business. And management has been extremely shareholder friendly with that cash. They've consistently bought back shares, reducing the share count and increasing per share value. They've grown the dividend every year. This capital allocation discipline is exactly what you want as a long-term shareholder. Now, Apple isn't cheap. At the current valuation, you're paying about 28 to 30 times earnings. That's a premium multiple. But I think it's justified given the quality of the business, the strength of the moat, the cash generation, and the growth potential in services. Over the next 5 to 10 years, I expect Apple to keep growing earnings at a reasonable rate, keep buying back shares, keep raising dividends. That should produce solid returns even from today's valuation. There's one more thing about Apple that's important for someone investing $10,000 in 2026. The company has proven it can navigate complex global challenges, regulatory scrutiny, supply chain disruptions, trade tensions, competitive threats. Apple has dealt with all of it and kept growing. That resilience and management capability gives me confidence the business will still be thriving in 2036 when I want to be counting my returns. My fourth allocation would be $2,000 into Coca-Cola. And I can already hear people saying, Warren, Coca-Cola, really? That's such a boring, old-fashioned business. It's not growing anymore. Why would a young person starting out put 20% of their portfolio into a slow-growth beverage company? Let me tell you why. Because this goes to the heart of what makes a great long-term investment. Coca-Cola sells happiness in a bottle for pocket change. A Coke costs, what, $2 or $3? For most people in the world, that's an affordable luxury. Something that makes you feel good without breaking the bank. And here's the key insight. Demand for affordable luxuries is remarkably stable across economic cycles. During recessions, people stop buying cars and taking vacations, but they don't stop buying Coke. During expansions, people buy more Coke. The product is essentially recession resistant. But stable demand alone doesn't make Coke a great investment. What makes it great is the combination of stable demand with the most valuable brand in the consumer products world. Coca-Cola's brand is recognized by 94% of the world's population. Think about that for a second. Nearly every human being on earth knows what Coca-Cola is. That brand recognition took more than a century and billions of dollars to build. Competitors can't replicate it. That brand allows Coke to maintain premium pricing relative to generic alternatives. It allows them to command shelf space in every retail outlet. It allows them to charge restaurants and entertainment venues for exclusive pouring rights. The brand is worth hundreds of billions of dollars, and it's Coke's ultimate competitive advantage. As long as that brand remains strong, and I see no reason it won't, Coca-Cola will keep generating reliable cash flows. Let's talk about the business model, because this is elegant. Coca-Cola doesn't actually bottle and distribute most of its products. The company makes concentrate and syrup, sells it to independent bottlers around the world, and those bottlers handle the capital-intensive parts of the business. This asset-light model means Coke generates phenomenal returns on invested capital. The company can grow without tying up massive amounts of money in manufacturing plants and distribution trucks. And then there's the dividend. Coca-Cola has raised its dividend every single year for 62 consecutive years. 62 years. Through recessions, inflation, wars, everything. That's an incredible testament to the reliability of the cash flows and management's commitment to shareholders. At the current price, the dividend yields about 3%. That means my $2,000 investment should generate about $60 in annual dividend income, which gets reinvested to buy more shares. Here's why this matters for someone building wealth from $10,000. Dividend growth compounds over time in a way that's almost magical. Let's say Coke grows its dividend at 6% annually, which is roughly its historical rate. In 10 years, my $60 annual dividend becomes $107. In 20 years, it becomes $192. And that's before accounting for share price appreciation. The combination of dividend growth and price appreciation has produced 10% plus annual returns for Coke shareholders over very long periods. But there's another reason I'd own Coca-Cola starting out. The stock teaches you patience. It's not going to double in the year. It's not going to be the hottest thing in your portfolio. Some years it'll barely move, but over decades, it quietly compounds wealth while paying you to wait. Learning to appreciate that kind of steady, reliable compounding is one of the most valuable lessons in investing. It keeps you from chasing shiny objects and making impulsive decisions. So that's my 4 positions: $3,500 in an S&P 500 index fund, $2,500 in Berkshire Hathaway, $2,000 in Apple, and $2,000 in Coca-Cola. That accounts for all $10,000, and it gives me a diversified portfolio of high-quality businesses with competitive advantages and solid management teams. But now let me talk about what's not in this portfolio, because that's equally important. You'll notice I don't own any individual banks. Banking can be a great business, but it's complicated and opaque. Assets are marked at historical cost, not market value. Leverage is high. Risk can be hidden. I understand banking, but if I only had $10,000, I wouldn't want significant exposure to bank-specific risks. The index fund gives me some exposure to JP Morgan, Bank of America, and other big banks, and that's sufficient. You won't see any speculative tech stocks. No recent IPOs trading at 50 times sales with no profits. No artificial intelligence plays that everyone swears will change the world. Maybe they will change the world, but I don't understand their business models well enough to bet significant money on them. And with only $10,000, I can't afford to speculate. I need every dollar working hard in businesses I trust. You won't see any pharmaceutical or biotech companies. I don't understand drug development pipelines. I can't evaluate whether a clinical trial will succeed or fail. These businesses require specialized expertise. I don't have. Again, the index fund gives me exposure to Eli Lilly, Johnson & Johnson, and other big pharma companies, and that's enough. You won't see any energy stocks or commodity plays. Oil and gas prices are unpredictable. The businesses are capital intensive and cyclical. Management teams often make poor decisions when prices are high, overinvesting in expansion right before the next downturn. I've made money in energy over the years, but it's not where I'd put my limited capital starting from scratch. And you definitely won't see any cryptocurrency or meme stocks or day trading positions. I've been very clear about my views on crypto. It's not an investment, it's speculation. It doesn't produce anything. It doesn't generate cash flows. Its value depends entirely on someone else being willing to pay more for it than you did. That's not investing. That's gambling. And I don't gamble with money. I'm trying to compound over decades. Now, let me talk about the discipline required to actually execute this strategy, because this is where most people fail. The hard part isn't picking good businesses. The hard part is holding them through the inevitable downturns and not doing something stupid when everyone around you is panicking or getting rich quick on the latest fad. If I invested this $10,000 in January of 2026 and the market crashed in March, my portfolio would fall maybe 20%, maybe 30%. My 10,000 would become 7,000 or 8,000. That's going to happen at some point. It's not a matter of if, it's a matter of when. Markets crash. It's what they do. And when it happens, I need to remember why I bought these businesses in the first place. Apple will still be selling iPhones during a crash. Coca-Cola will still be selling drinks. Berkshire will still own its businesses and have cash to deploy and at bargain prices. The S&P 500 companies will still be generating revenue and profits. Nothing fundamental will have changed. Just the prices will have fallen because people are scared. And if I've truly bought wonderful businesses at reasonable prices, a market crash is a buying opportunity, not a reason to panic. This is why I'd set up automatic dividend reinvestment for this portfolio. Every time Coke or Apple or Berkshire pays a dividend, it automatically buys more shares. No effort required, no decisions to make, just systematic reinvestment at whatever price happens to be available. During crashes, those dividends buy more shares. During booms, they buy fewer shares. Over decades, this disciplined reinvestment compounds wealth remarkably effectively. I'd also commit to adding money to this portfolio regularly, even if it's just $100 or $200 per month. The discipline of regular investment, sometimes called dollar cost averaging, removes emotion from the equation. You're buying whether markets are up or down, whether you feel optimistic or pessimistic. You're just systematically accumulating shares of businesses you want to own. This habit is worth more than any hot stock tip. Let me paint you a picture of what this $10,000 portfolio could become over time if I stick to the plan. Let's assume the portfolio returns 10% annually on average, which is reasonable given the holdings. In 5 years, my 10,000 becomes 16,000. In 10 years, it's 26,000. In 20 years, it's 67,000. In 30 years, it's 174,000. And in 40 years, it's over 450,000. But here's where it gets really interesting. If I add just $200 per month to this portfolio, reinvest all dividends and earn 10% annually, the numbers change dramatically. After 30 years, I'm looking at over $500,000. After 40 years, it's over $1.4 million. That's life-changing wealth built from $10,000 and small monthly contributions. No lottery tickets, no get-rich-quick schemes, no speculation, just patient, disciplined investing in quality businesses. The key is starting early and letting compound interest work for decades. Einstein supposedly called compound interest the most powerful force in the universe. I don't know if he actually said that, but it's true regardless. When you're young and investing for retirement, 30 or 40 years in the future, time is your greatest asset. You can afford to be patient because you have decades for businesses to grow, dividends to compound, and returns to multiply. But compound interest only works if you don't interrupt it. Every time you sell because you're scared, every time you chase a hot tip and lose money, every time you withdraw funds for consumption instead of letting them compound, you reset the clock. You break the exponential curve. This is why discipline and patience are more important than intelligence or market timing or picking the perfect stocks. Let me address a question I know some people have. Warren, you've talked about 4 positions in this $10,000 portfolio, but what about rebalancing? What about adjusting allocations as prices change? Should I sell some Apple if it runs up and buy more Coca-Cola if it falls? My answer is probably not. Here's why. First, selling generates taxes on gains. If I bought Apple at $200 and it runs to $300, selling means paying capital gains tax on that $100 profit. That's like giving the government 20% or more of my gains. I'd rather let it ride and keep compounding tax deferred. The only time I'd consider selling is if something fundamental changed about the business. If Apple lost its competitive advantage or management started making poor decisions. But I wouldn't sell just because the price went up. Second, my best investments over the decades have been the ones I didn't sell. I've held Coca-Cola since 1988. I've held American Express since the 1960s. These positions have compounded for decades, and the returns have been extraordinary. If I'd been constantly rebalancing and trimming winners, I'd have missed out on enormous gains. So my bias is to let winners run and resist the urge to tinker. That said, I would add new money to whichever position seemed most attractive at the time. If Coke fell to a very attractive valuation while Apple was expensive, I'd direct new contributions toward Coke. But I wouldn't sell Apple to make that happen. I just let allocations drift over time based on business performance and where I could deploy new capital most effectively. There's another aspect of this portfolio I want to discuss, and that's temperament. Having the right temperament is more important than having a high IQ or access to sophisticated analysis. I've seen brilliant people fail as investors because they couldn't control their emotions. They bought high when everyone was euphoric and sold low when everyone was panicking. They chased returns, made impulsive decisions, and let short-term thinking dominate. The temperament you need is simple but rare. You need to be patient when nothing is happening. You need to be calm when prices are falling. You need to be rational when everyone around you is losing their minds. You need to ignore noise and focus on fundamentals. You need to think independently rather than following the crowd. These sound like obvious virtues, but they're incredibly difficult to practice consistently. I'll give you an example. Let's say it's 2027 and artificial intelligence stocks have gone absolutely crazy. Companies with any AI connection are trading at astronomical valuations. Everyone you know is making money hand over fist in AI stocks. Your portfolio of Apple, Coke, and Berkshire is plodding along with steady but unspectacular returns. The temptation to abandon your strategy and chase the hot sector will be enormous. This is the test. Can you stick to your knitting when everyone else seems to be getting rich faster than you? Can you stay disciplined when your strategy looks boring and outdated? Can you ignore the noise and trust in the businesses you own? I've faced this test many times. In the late 90s, when tech stocks were soaring and everyone thought I was a dinosaur for not buying them. In the 2010s, when momentum stocks were crushing value stocks year after year, every single time, patience was rewarded. The fads ended, the bubbles burst, and the boring businesses I owned kept compounding value. But in the moment, it didn't feel good. It felt like I was missing out, like I was making a mistake, like I was too conservative. You have to be able to handle those feelings and stick to your principles anyway. That's what separates successful long-term investors from everyone else. Let me also talk about what I'd be doing beyond just holding these 4 positions. I'd be reading everything I could about business and investing. Annual reports, investor letters, books about successful investors, articles about different industries. I'd be building my knowledge base so that 5 or 10 years from now, when I had more capital to deploy, I'd be ready to identify opportunities others miss. I'd study annual reports of companies I don't own, trying to understand different business models and competitive dynamics. I'd read Berkshire's annual letter every year, not just because I own the stock, but because it's a masterclass in business thinking. I'd read about past market cycles and crashes to understand how investors behaved and what strategies worked. Knowledge compounds just like money, and the more you know, the better decisions you'll make. I'd also be thinking about tax optimization, which becomes more important as your portfolio grows. Holding stocks for more than a year to qualify for long-term capital gains rates. Maxing out tax-advantaged accounts like IRAs and 401ks. Understanding the tax treatment of dividends. These details might seem boring, but over decades they make a material difference in after-tax returns. Keeping an extra 1 or 2% per year by being tax efficient compounds into hundreds of thousands of dollars over a lifetime. And I'd be living below my means so I could keep adding to my investments. This is crucial. If I'm spending every dollar I earn, my $10,000 portfolio will grow at whatever rate the market gives me. But if I can save $500 or $1,000 a month to invest, my wealth will grow much faster. The combination of investment returns and systematic savings is incredibly powerful. Many people focus entirely on returns and ignore savings. But savings is the variable you actually control. Here's something else I'd be doing with this portfolio. Absolutely nothing. I wouldn't be checking prices every day. I wouldn't be reading market commentary or watching financial news. I wouldn't be obsessing over whether the Federal Reserve is raising or lowering interest rates. All of that is noise. None of it changes the fundamental value of the businesses I own. Checking prices constantly just creates anxiety and temptation to do something, and doing something is usually the wrong move. I'd probably check my portfolio quarterly just to make sure dividends are being reinvested properly and to look for opportunities to add more capital, but that's it. The rest of the time, I'd be focused on my career, my relationships, my life. Building wealth should enhance your life, not consume it. If you're constantly stressed about your portfolio, you're doing it wrong. Let me address one more question that I know is on people's minds. Warren, this strategy sounds great for someone who's patient and has decades to invest, but what if I need money sooner? What if I'm saving for a house down payment in 5 years or for my kids' education in 10 years? Should I still invest in stocks? And my answer is it depends on your true time horizon and your tolerance for volatility. If you absolutely need the money in 5 years and can't afford to see it decline 30 or 40%, then stocks are probably too risky. You should be in high quality bonds or CDs or money market funds. The returns will be lower, but you'll have certainty about principal preservation. Stocks are volatile in the short run. They can fall 50% and take years to recover. You don't want to be forced to sell at the worst possible time because you need the money. But if your time horizon is truly 10 years or longer, and you can handle seeing the value of your portfolio fluctuate, then stocks have historically been the best option for building wealth. The S&P 500 has never had a negative return over any rolling 20-year period. Think about that. If you bought at any point in history and held for 20 years, you made money, usually quite a lot of money. That's the power of owning productive businesses over long periods. This is why I emphasize time horizon so much. The strategy I've laid out with concentrated positions in wonderful businesses works brilliantly if you can be patient for decades. It works poorly if you're trying to time markets or trade frequently or need the money soon. Know yourself, know your goals, and invest accordingly. Let me wind this down with some final thoughts on what this $10,000 portfolio represents. It's not about getting rich quick. It's not about beating the market every year. It's not about finding the next Amazon or Apple before anyone else. It's about owning pieces of wonderful businesses at reasonable prices and letting them compound for decades. It's about discipline and patience and rational thinking in a world that rewards none of those things in the short run, but all of them in the long run. If I had to start over with $10,000 today, I'd be optimistic about my chances of building significant wealth over time. Not because I'm smarter than everyone else or because I have access to secret information, but because I understand what works. I know that owning great businesses for long periods creates wealth. I know that starting early gives compound interest time to work magic. I know that avoiding stupidity is more important than seeking brilliance. The portfolio I've described, 35% in an S&P 500 index fund, 25% in Berkshire Hathaway, 20% in Apple, and 20% in Coca-Cola, isn't perfect. Someone else might allocate differently or choose different stocks. That's fine. What matters is the underlying principles. Own quality, diversify adequately, think long-term, stay disciplined, keep costs low, and be patient. Do that with $10,000. Add to it consistently, reinvest dividends religiously, and resist the temptation to do something stupid when markets get crazy in either direction, and you'll be amazed at what you can build over 20, 30, or 40 years. Not because investing is magic or because stocks always go up, but because owning productive assets in a growing economy, managed by capable people and held through complete market cycles, is one of the most reliable ways to build wealth that humans have ever discovered. That's what I'd do with $10,000 in 2026. And I'd sleep well every night knowing I own pieces of wonderful businesses that would still be thriving in 2046, 2056, and beyond. That's all that matters. Everything else is just noise.